Hi, this video is about the capital structure. What do you mean by capital structure of a company? It is a composition of a company's sources of fund, a mix of owner's capital, that is equity, and a loan, that is debt, from outsiders. It is used to finance its overall operations and investment activities. The owner's capital is in the form of equity shares, otherwise called as common stock. Preference shares or preference stocks or any other form that is eligible to control the entity's retained earnings of the entity. Debt capital is in the form of the issue of bonds or a financial banker. Capital structure is a very critical factor in the case of project financing. The bankers are concerned about the initial percentage of funding to the proposed project and usually assist with up to 70% of the project cost. Debt and equity capital are used to fund business operations, capital expenditures, acquisitions, and other investments. There are trade-offs firms have to make when they decide whether to use debt or equity to finance operations, and the managers will balance the two to find the optimal capital structure. What do you mean by optimal capital structure? It is often defined as a proportion of debt and equity that result in the lowest weighted average cost of capital for the firm. If the company's weighted average cost of capital is lower than that of previous year, means it is good. If it is keep on increasing, means it is not good for the company. The technical definition is not always used in practice. The firms often have a strategic or a philosophical view of what the ideal structure should be. Basically, there is no standard formula or there is no standard ratio for optimal capital structure. It depends upon the firm's strategy. In order to optimize the structure of a firm, the firm can issue either more debt or equity. The new capital that's acquired may be used to invest in new assets or may be used to repurchase debt or equity that's currently outstanding as a form of recapitalizations. This table depicts the balance sheet of a particular company. It shows the debt and equity portion, in which you can find out the capital structure of a company. WACC. Capital structure by industry. Capital structure can vary significantly by industry. Cyclical industries like mining are often not suitable for debt, as their cash flows profiles can be unpredictable and there is too much uncertainty about their liability to repay the debt. Other industries like banking and insurance use huge amount of leverage and their business models require large amount of debt. Private companies may have a harder time using debt over equity, particularly small business, which are required to have a personal guarantees from their owners. A firm that decides it should optimize its capital structure by changing the mix of debt. So the company can optimize their capital structure by changing the mix of debt. For example, 50% equity, 50% debt, or 60-40 or 70-30, like that. Depends upon the company and the industry. The methods of recapitalization include issue of debt and repurchase equity, and issue of debt and pay large dividend to equity investors, issue of equity and repay the debt. Each of these three methods can be an effective way of recapitalizing the business. In the first approach, the firm borrows money by issuing debt and then uses all of capital to repurchase the shares from its equity investors. This has the effect of increasing the amount of debt and decreasing the amount of equity on the balance sheet. In the second approach, that is issue debt and pay large dividend to the equity shareholders. The firm will borrow money by issuing debt and use those money to pay one-time special dividend, which has the effect of reducing the value of equity by the value of dividend. This is another method of increasing debt and reducing the equity. In the third approach, the firm moves to opposite direction, issues equity by selling new shares, then takes the money and uses it to repay the debt. Since equity is costlier than debt, this approach is not desirable by any company and often only done when a firm is over leveraged and desperately needs to reduce its debt. For that kind of company, this method is useful. Thank you.